trends. Now, we're just getting some of these results out from Microsoft and Alphabet. So let's take a look at what we've got. Microsoft first, because there's been a lot of focus on Microsoft most recently because it became the most valuable company in the world, passing that $3 trillion valuation. And just taking a look at the results for the quarter, it does look like a beat when it comes to second quarter revenue and profit. So revenue for the second quarter coming in at $62 billion. The expectation was just over $61 billion. When you're looking at second quarter cloud revenue, that was also a beat, $33.7 billion instead of $32.2. Earnings per share coming in at $2.93 instead of $2.78. So, yeah, just taking a look at those headlines there for Microsoft. We'll keep digging into the numbers, but you know what? We're going to bring in Mike Archibald. He's Vice President and Portfolio Manager at AGF Investments. Mike, thanks so much for joining us this afternoon.
Thanks very much for having me.
So we're just going through Microsoft's results here, and I wonder if there's, anything in particular that's jumping out to you from these results. It does look like a beat, or anything in particular that you're going to be digging a little bit deeper into when it comes to these results.
Yeah, so I think you hit the main points in your introduction there. It looks like it's a beat across the board in most segments. I think the main thing that the market was looking for is just what does the cloud growth look like. It's projected to be up 27-28%, and that looks like a beat to consensus. I think what's going to matter for this stock is what they provide with respect to guidance, and they're going to do that on the call at 5:30. So clearly the expectations for Microsoft are quite high. As you mentioned, you're really the AI leader and the darling in this space, and so clearly it's a beat, but I think maybe the expectations were certainly above where consensus was at. So I think what's really going to matter, as I said, is what kind of guidance they give on both the kind of co-pilot adoption rates and what cloud growth looks like for the upcoming quarter. I'm
just looking at Alphabet's results as well. So let's go through those a bit here too. So it looks like just overall revenue for the quarter was a beat. So $86 billion versus $85 billion roughly was the expectation. However, when we're looking at Alphabet and after-hours trading, it looks like it is falling. And I'm seeing some red headlines about Google's ad revenue missing. So when we take a look at the ad revenue for, I think for YouTube, it was a beat, 9.2. But the Google ad revenue, just sort of overall, $65.52 billion. The expectation was $65.8. So very close to the expectation there. But perhaps the expectation of the market was for more of a beat even. Mike, how would you wrap your head around that so far?
Yeah, I would agree with that. I mean, there's no room for error in these Magnificent Seven stocks, right? They have very, very high expectations. This is the same as Microsoft, although Microsoft's bouncing back to flat here. Definitely, I think the bar was actually lower for Alphabet, to be perfectly honest with you. It's not as over-owned as Microsoft is. So going to need to dig a little bit more into what the outlook is for ad spending. I think 2024 should look better than 2023. You have the Olympics and you have the U.S. election, so that should be helpful for ad spending. Also got to take a look into sort of what their cloud growth looks like. So they lag behind Microsoft, but we'll have to take a peek to see if that's part of the disappointment. But yes, the stock is down about 5.5% right now. So there's obviously something else in the numbers that's causing concern for the marketplace here.
Yeah, we'll keep following and digging into that. I do see one headline here that's sort of interesting for some other conversations we've been having recently, but Alphabet saying that it's taking actions to optimize our global office space. So might not be a good signal for those in the office space sector right now. Mike, it's interesting when it comes to these two tech giants. These aren't actually companies that you hold, and I just wonder why that is.
Yeah, so I'm focused more on the Canadian marketplace. We do have exposure at AGF to both Alphabet and Microsoft, both very good companies. We've certainly looked for exposure to other names that have, technology, better technology growth than some of these names. So we do have some exposure to these across the firm, but they're not held in the candidates that I own. I guess I would just say your other point on Alphabet, cost cutting is certainly going to be a key theme, I think, in Q4 reports across the board. There's been some interesting information out recently about layoffs, potentially some more cost cutting at Alphabet, and looks like we're seeing some of that. So we'll have to see. They're probably going to be focusing a little bit more of their time and efforts on building out the AI segments, and so we'll have to see if we get a little bit more information as to what the impact is there on margins and efficiencies for Alphabet moving forward.
Yeah, according to a site that tracks layoffs, about 23,000 workers have been laid off just in the month of January. It's a part of a tracking of the tech sector layoffs. And then I was just mentioning PayPal cutting jobs today as well, another 2,500 there. So you think there could be more to come on that front in terms of layoffs?
I think that's a theme. Clearly, there's obviously a bit of a slowdown that we've seen in the U.S. economy in the last little while, although still growing. And so, in order to preserve margins, companies are going to have to look to cut costs. And as we know, wages have been relatively sticky to the upside. So, trying to get to reduce headcount is certainly one way to do that. And you've certainly seen over the long term, use Meta as an example about a year ago, when you can put in cost-cutting initiatives, stocks generally tend to act fairly well. So you're certainly seeing a number of those announcements today, as you mentioned.
When it comes to Canadian earnings results, are you expecting some negative estimate revisions as we make our way through the season here?
Yeah, likely. I mean, Canada's looking to have probably earnings at the index level down about 1% year on year. So the commodity space is going to be quite tough, obviously, just with the move that we've seen in commodities, and costs remain a little bit too high for a number of those businesses. The real areas that you're going to see strength in, I think, in Canada are probably in technology, which are relatively asset-light businesses, and industrials, particularly the engineering and construction companies. So overall, Canada, the growth rate in earnings in Canada has been relatively flat for call it 2 years. Looks like we're going to start to accelerate as we move through 2024. But I would say this quarter, you probably aren't going to see a ton of upside in overall numbers. But, depending on which sectors you're looking at, as I said, technology is one area that will be a standout, should also be a standout in the U.S. marketplace. That's really where we've seen most of the upward revisions in both Canada and the U.S. coming from the technology sector.